A few surprises. If people thought it was an interim budget, it was only in the length of the budget speech, because otherwise, some of the announcements that have come out are stellar, and we'll talk about it editorially and then get in our guests to talk about this. But I think what stood out amidst all the assumptions that they've made around receipts, tax receipts and expenditures for FY24, the budgeted actual numbers, and for FY25, I think the standout announcement is fiscal deficit as a percentage of GDP for FY25 at 5.1%. I must say, guys, nobody thought about this when they were penciling their estimates.
The base case was 5.2 at best.
At best, maybe 5.3.
Even the net borrowing, and I think the bond markets have reacted, not significantly yet. The rupee is sub 83, so that's a good thing. Bonds have gone down about 7 basis points, so not a big move on the bond market, but it will play out. Banking stocks as well should be in focus zone.
Yes. So top takeaways, if we had to put it, and Neeraj is absolutely right. Fiscal deficit targets are better than expected. She's sticking to 4.5% for FY26, no moving from there. For the current year, it's below what the government had projected. They projected 5.9. It's at 5.8%. And remember, for the interim year, how do you get to that 4.6 or 4.5%? Well, the figure she's given is 5.1%. The estimate was between 5.1 to 5.3. Borrowings are lower than expected in FY25. Revenue receipts are higher than expected in FY24. And no changes in tax.
Just a quick one on capex.
That's what I'm saying.
Jump.
Expenditure.
11% odd is better than 10% is what the street was penciling, working with. The number that she's given out is 11.1% increase in capex. So that number looking far better. And I think the street infrastructure, the sectors that we've been talking about, railways, will see a rally. And we've seen that play out in the last few days, last few minutes. Yeah. Another smaller sector, and I know I talked about this early in the day, and I didn't really think much was going to come out, was tourism. Those counters also getting excited. So clearly things are working and on track in terms of what the expectation was. But Neeraj, Tamanna, surprising, I think the equity market would start seeing some buying into a bit of a runaway. Nothing's happened on the street.
Well, I think the capex outlay being lower is something that doesn't work.
11.
Yeah, but relative to 30%.
11%.
Yeah, but relative to 30%.
It's a 10% jump.
It's 11.1% uptake relative to previous year. But the point being, because of the previous 3 years, and Mihir, what I was with us in the panel, he was saying that anything below 20% might be something that might be disappointing for the market because they're used to 30-odd%.
Even I think Citibank's report was exactly that. They were working with 20%.
So multiple things have happened, right? And our guests should be with us any moment and we should talk to them. But maybe, one, the 5.8 trending number, and two, the 5.1 confidence comes from these three things. Capex outlay not very high, 11.1. Receipts much better. And the gross borrowing number, 14.1 lakh crores. It is much, much lower. Pranjul Bhandari was on record saying that any number lower than 15.2 or 15.1 is going to be viewed positively. And I think that is what has happened.
Back to the story of the fact that we've made these commitments, right? You've talked, and also talking about GDP, fiscal deficit, she said below 4.5.
Yeah.
Not even 4.6 and not even
very positive there.
With a lot of conviction, it's going to be below 4.5. And also what was probably a way to look at it, not too many populist measures as such.
Yes,
that could also be viewed in correct light. Some disappointment on the tax front. There were, I guess, units of people expecting a little bit of tweaking on taxation, but like Mihir and me discussed this earlier, no tweaking on taxation.
And which is also great news.
But
well, people would like it. But let's tweaking. No, we don't want negative taxation. But just before we get to our guests, a quick market check. The Sensex and the Nifty are flattish. On the index, not too much of a movement really because of the budget, if you will. On the index heavyweights I'm talking about. So auto still higher and doing okay. And that continues. So the Marutis, M&Ms of the world, no big moves there or no big developments there. But I'm just saying that the moves on the index are largely muted because the Sensex and the Nifty, in fact, now 0.22%. So kind of reeling a bit under pressure. Now, if we have our guests ready, we should go to our guests and try and get initial views from all of them. Let me start with, to my extreme left, Maneesh. Quick initial thoughts. What did you make of the numbers?
So it's a as we said ahead of the budget, it's going to be a bond budget. So it's a disinflation budget. Basically, the expenditure is going up only at 6%, lower than even what I thought, 7-odd%. Primary expenditure is even lower, which is X subsidy, X interest is likely at 4-5%. one of the lowest in last 20 years. Fiscal deficit is actually versus market expectation of 5.3, 5.4, it's 5.1. So it's sort of paving way for a pivot for monetary policy. That look, we've done enough. Capex, there's been a substantial jump. So let's sort of get into a little bit of a conservative mode now, so that we pave way for monetary policy to ease. AMIs can come off, liquidity can improve. So in a sense, the onus of actually re-stimulating growth at margin, if at all they were to be slowed down, is going to be with monetary policy, not fiscal. So if purely from the point of view of, let's say, if you're looking for a growth budget, it's not a growth budget. It's a disinflation budget, and which essentially is going to be for long-term, medium-term very good, because government has done a lot of things. There is going to be disappointment in terms of like market expectation on capex was about 14, 15%. I was actually thinking of only 11, 12%, so not disappointed because I mean, even this year, there's a 50, 75,000 crore worth of shortfall in terms of total capex spend so far that they've done. So it's 11% is a decent number. 3.4% as a percentage of GDP is not going to rise. So a lot of people were thinking that it'll rise to 4% of GDP in terms of capex. I think we've sort of hit a ceiling there. And this is all the capacity of the government is right now. So I think incrementally, the pivot will be back to a 2016-18 regime, where you'll have a 4.5% fiscal deficit in 1 or 2 years' time, and then mostly the local household and the private sector actually sort of re-stimulating or helping economy grow instead of government pushing it through capex.
Do you think the onus now will be on the RBI when they meet for the next policy meet? So I think that will be more directional in nature then.
That's the beauty of this, the SKD and Modi tango, so to say, I kind of call it, because unlike the previous regimes, these guys tango very well. So far it was fisc, and then now sort of the fisc is withdrawing so that monetary policy can actually accommodate.
Okay, Rajiv, Anand is also joining us now on our first quick takes of the budget. Rajiv Anand, Deputy MD, Axis Bank, with us. Very good afternoon to you, Rajiv. The conversation in here saying that it is not a growth budget, but positive on all the key factors. Your fiscal deficit targets matched for this year, better than expected. Capex at 11%, maybe lower than what the street wanted, but you're showing a continuum of growth. What's your first take?
I think I don't want to get into the semantics on whether this is a growth budget or not, but I think clearly shows the intent that the fiscal deficit is going to be managed as we get into the next 5 years as well, which is fantastic. And I think you're already seeing the fact that where the market is expecting fiscal deficit at about 5.4%, 5.1% for next year is a pleasant surprise. And I think if you look at the fiscal arithmetic as well, I think it's quite credible at this point in time. We've already seen the 10-year bond yields rally about 10 basis points on the back of that. I did hear some conversation around allocation to capital expenditure. I think capital expenditure increase is higher than the overall increase in expenses, which I think is positive again. I would have expected a little more on creating more demand at the rural level, not just more importantly creating more rural income, but perhaps that is there in the details, and maybe we can figure this out as we go forward. But I think overall a budget that I think one should be quite satisfied with.
Yeah. Rajiv, just a quick follow-up in terms of the borrowing figure and the point that the finance minister also made, that there is going to be a curtailment in government borrowing better than what the street and the broad expectations are, to be able to give enough room for the private sector. Do you think that is now expected to play out? Are you happy with that number?
I think, like I said to you, the fiscal arithmetic is credible. And so therefore, by definition, the expectation in terms of the gross borrowing program, approximately in the vicinity of about 14 lakh crores, I think is something that the markets are quite comfortable to work with as we get into 24-25. We are certainly we are certainly seeing private capex has kicked in over the last 8 to 12 quarters. One of the things that's certainly happening is the fact that because of the fact that corporate cash flows have been quite strong, much of this private capex has been funded by internal accruals. not so good as the head of a corporate bank, but I think it just is symptomatic of what a solid state corporate balance sheets are at this point in time. And perhaps looking at this budget, and once we get the uncertainty of the elections out of the way, I think it's fair to expect that corporate India will push the pedal on private capex as we go forward.
Rajiv, just a quick follow-up on what you said. So net borrowing numbers come in lower than expected. You've got that 25 billion that's going to come our way on back of India's inclusion in the JPM. In terms of, and of course, you've got the onus now shifted to the RBI through a monetary policy measure in the next meeting. In terms of outlook or trajectory on the 10-year, what are you working with? We've already seen a 9 basis point movement, like you said, was an instant knee-jerk reaction for now.
I think if you look at the curve is very flat at the moment. I mean, overnight funding rate is at 675. The 10-year is close to 712, 713 at this point in time. I think the focus for all bankers is really to see, when the funding rates at the short end will begin to ease, which will bring down the short end of the curve from overnight to, let's say, up to 5 years. Down at this point in time. Liquidity in the system is quite tight, and as a result of that, you've already seen the fact that funding rates or cost of funds for banks has certainly gone up. That has certainly put some pressure on NIMs, for banks, and I think as banks, not so much about the 10-year, but I think the focus is to see when liquidity in the system will come back. I do hope that perhaps once the first rate cut in the US happens, and two is when the flows of money, thanks to the JP Morgan index inclusion, happens sometime in June, we will see some easing of liquidity. So really the focus of attention is around liquidity. I think there isn't that much space for the 10-year to move at this point in time.
Right. By the way, just want to mark that the EY think tank is with us in our studios and giving us all the intelligence, and it will be up on your screen as well. In a moment from now, we'll speak to Pranav Sayta as well and get his view too. But Rajiv, just one quick question before Shankkar comes in with a question too. I heard you mention that the state capex has been strong. For some people, that's been the story of FY24, if you will, a 40% uptick there. Could that play a part in ensuring that the capex momentum stays high? Because not that the central government has anyways lived up to the whole amount of the capex that was the budget estimate per se. So is this not too disappointing, or are you disappointed with this 11.1% number?
I think what I mentioned was the fact that private capex has been quite strong, although much of that private capex is getting funded by internal accruals. But I think, to the point that you're making about state and state capex, I think that's really where the game is as far as India is concerned. We are seeing, healthy competition among states. We are seeing execution, although execution is different in terms of quantity and quality across all states. And given the fact that such a large percentage of central revenues is getting, there is devolution to the state governments, ultimately the onus of capex execution will rest with the state governments.
Hi Rajiv, this is Shankkar here. I had a question.
Hi, Shankkar.
Over the past few weeks, particularly after the bank results, there's been a lot of conversation about the credit deposit ratio. The mystery sort of is why deposits are growing slower than credit, and even though the GDP is growing faster. Do you think that if this budget sort of dips in, brings in a disinflationary, brings down the cost of capital, that part of the challenge that the financial sector faces will come down? I mean, this question is in two parts. What explains the lag in deposit growth, and would this budget address that?
I certainly do hope so. Like I mentioned to you, the focus of attention of most banks at this point in time, or most bankers at this point in time, is around liquidity. And I think what we've seen is there are multiple issues that we're currently grappling with. There's a large cash balance that's sitting with the government. That is creating some tightness in liquidity. Currency in circulation is beginning to inch up as it typically does as we get closer to elections. And we've seen outflows of FX, and to that extent has created some element of pressure on the liquidity. Ultimately, I think we will have to see some monetary action. Whether it is many more VRRs, OMO activity, or even a CRR cut at some point in time for this liquidity to ease as we go forward. Perhaps some of this liquidity has been tightened because of future cash flows that we are expecting. The JP Morgan bond index inclusion flows. For example, it is not very clear whether the RBI has not clearly articulated what exactly its thinking is at this point in time around this.
Okay, that sort of sets up the floor for the financial sector stocks.
Yeah.
Yes, indeed. Great. Rajiv, take a moment to thank you for joining in today and giving us your perspective. Really appreciate your time and your thoughts this morning. Now, a disinflation. No, the pleasure is entirely ours. Again, sticking to my left, Ravi, come to you. Thanks for joining in. A disinflationary budget, rightly pointed out by Maneesh. Rajiv seconds that as well. Is that disinflationary for real assets, real estate, equity markets, or do you think this capex outlay number, not a negative, but a dip, if you will, but the deficit numbers looking positive, the markets will take it in their stride?
No, I think clearly there's a small bit of disappointment on the capex number, but coming on the base of a very high number last year, even though they didn't achieve their budgeted estimate, but it's still a credible number of 30-31%. On top of that, another 11% growth is not a bad number. So from an equity markets perspective, we were always looking at it from the credibility and continuity aspect. And I think on both the things, the budget has delivered. There is credibility in the numbers, whether it is on the revenue estimate side or whether it is on the tax buoyancy numbers. So we are absolutely okay. And there is some positive surprise on the fiscal deficit front. So that broadly, I think as Maneesh mentioned earlier, it's more a bond market budget than an equity markets budget. From our perspective, I think most of the focus is a continuation of which are the sectors that the government is going to focus on. And it's not so much of a needle mover, honestly. I think the mantle moves now to RBI, the elections up ahead, and even in US elections, and how those events are going to pan out is what is going to determine the way the equity markets are going to move.
Ravi, just point then, I just want to point out what PSU bank stocks are doing today, and you're seeing that uptick quite positively on PSU bank stocks. So the overall market is just, I think, absorbing everything that's happening right now. In terms of impact of capex, Ravi, I wanted to get a sense from you on what happens to all of those pockets of stocks, companies, which have been fueled by large government spends. We don't yet know the exact figure for the railway outlay. Do you see any impact there on infra, etc.? Do you see some cool off there in expectations of how much work is going to flow to these individual companies?
No, so first of all, even though central budget was doing bulk of the heavy lifting, going forward that mix has to change. Central government cannot be doing that much heavy lifting going on. The limits have been reached in terms of how much fiscal space they have. It will be the state government and the private capex that will have to do bulk of the heavy lifting in capex going forward. From that perspective, railway and defense are two sectors which are dependent on the central government capex. We'll have to take a look at what the breakup of that 11% is before I can say that if there is going to be any kind of a negative impact.
In fact, those stocks, rail stocks, Taman, have already started seeing a little bit of a decline. So post the budget, all your IRFC, RailTel, are seeing RVNL are all trading with some weakness. So the reaction, clearly, at least for now, knee-jerk it may be, is negative. Pranav, you want to come in? Are you impressed by what numbers are put out? I mean, I think people are expecting an overshoot on the fiscal deficit for this year. We've done really well, and going out as well into next year, those numbers look promising.
Absolutely. So the way I look at it is this is a prudent and confident budget. I think the finance minister seems to have a lot of confidence that growth will sustain, even if the capex is not at the same level as was probably expected by the markets. I think here she is also betting a little bit on the fact that if the borrowing of the central government is to be lower, automatically there will be more available for the private sector, and the capital expenditure push at the private sector, which has so far been a little elusive, will kick in a much stronger way. So I would feel that she is really betted on a far more confident approach, that if I control the fiscal deficit, this government has been very prudent on the macros. And this step, again, while the whole world seems to be still with a lot of fiscal deficits, already seems to be very conservative from a fiscal deficit point of view. So I think she is betting on that the fact that the macros will be good, will bring in foreign investment, will also push the Indian private sector to invest much more. Funds will be available for private sector capex. So I think it's a big bet that she is making on growth sustaining despite this particular.
In fact, that's been a priority for the Prime Minister, putting India on the global map. And we have seen that over the last decade. Things have changed and they've moved. And I think just credibility is what we're currently building. And the focus is clear.
Absolutely. And that also brings in foreign investment in a much bigger way.
I mean, FDI is a big, big push.
So I mean, if the world feels that India is already very stable, one positive sign, and if its fiscal and macro policies are going to be continuously prudent, it probably might just give a big push to private sector capex, including foreign investments.
So the question to the jury at large, does private capex kick in a big way at a point of time when the world is not quite certain, and in a year which has got massive elections lined up? Shankkar, you may want to start this, but the question to everybody.
I think it will depend largely on global cues. You see, one of the issues has been addressed, which is the cost of capital that was inhibiting private capex growth. So by doing this, by reducing the government's footprint in the borrowings market, it has created little room for the private sector. But that little room also has to be supplanted by rise in deposits, which is why Rajiv Anand spoke about the CRR issue. And so the CD ratio, whatever, people have cooked an avial out of it, but nobody knows what is the actual number that should be there. But if the liquidity improves, if the demand improves, but private capex is also haunted by the sectoral definition of the budget allocations. You see, the expectation for everyone was there would be something done for rural demand. Now that is an area that is sort of still wherever it is. Capex was expected to be higher, but is at 11. I think it's a very credible figure because there is only so much that governments can execute.
Yeah.
The absorptive capacity of the economy has limitations. So over a period of time, we will see that. The money coming in from JP Morgan and other indexes is coming into the debt market, which will be only sovereign debt, so it will sort of create room for private borrowers. But they will borrow only when they see a certainty, when they see growth ahead, when they see consumption moving up. And that's a big if in a year where the global environment is sort of uncertain. Mercifully, the IMF has upped the global output. Maybe these wars would sort of clear, the fog of war would clear out. And I still think that there is a latent desire to invest in the private sector, which might be unleashed if the correct kind of persuasion comes on. And the tax policies will play a big role. PLI will play a big role in this.
We didn't see too much of mention on that. Maybe we save for the budget. But
just one second, before we beat the government too much on the growth, just one thing. The FY24 capex number has actually been revised downwards from 10 lakh to 9.5 lakh crores. So on base of that, 11.1 is actually a 17% growth.
Got it.
So it's not like
even the effective capex is a very good number.
Yeah.
No. So not beating it, because as Maneesh said in his opening answer, right, that if you set the limits and we see they've not done this much as well, and the state government capex is anyways 40% growth, so there's a bit of a thing there. But the question only is that private capex and household capex, not quite there, and which is my question, that if they have not done anything in the budget, what Mr. Sayta said, that is the FM sounding confident of growth coming back, but can private capex come back in a year when global growth is looking slightly faulty?
No, I think from the central government's point of view, they have laid the ground in terms of, like you mentioned, about bringing the cost of capital down, building the confidence in the business, providing policies which are supportive of particular sector. And global confidence also in India's economy growing is also on a high. So, I mean, I don't see any missing piece in terms of the jigsaw, in terms of private capex picking up. How much pace and all we can keep debating, but I do directionally for sure private capex has to pick up.
So, a quick one. There was nothing said on divestment again this time. So that also was a missing piece. Nothing really expected after the disappointment.
Lesser said the better.
So to be fair,
Sorry, but just Maneesh wanted to make a point on capex before we move on. Sorry, Maneesh.
Did I? Okay.
Yeah, because I thought you were wanting to answer. And Ravi
I was just keenly listening to him. No, capex actually, I mean, if you have 100 buck of capex in a country, only 25 is done by government and 40 is done by household. Okay, so private capex is not Reliance Industries and companies of capex. It's about 40% is household, and that sort of has been pretty weak for very long, for good 8-10 years. And because half the households are borrowing money in some form or other, okay, I think a monetary policy is a better way to reach them. Okay, so I mean, there in the budget speech in the beginning, she talked about 3 major reforms. One of them was middle class housing, and I think in July, as and when she sort of unleashes the next set of things for the 25-year of a developed country, I mean, she would and she should, and I think every Dharavi, every slum guy should be able to move to a Virars and Vasais of the world in a decent 2 BHK. Is what the government should do, which is to lower interest rates, create subsidies, everything that Hong Kong's and many other East Asian countries have done. If we do that, we will have a decent capex. If you're looking for a capex like 2000s, where the huge unleashing of telecom and power infra happened, and 20-25% CAGR happened, that's not going to happen. India's sort of basic foundation of a hardcore capital-intensive infrastructure is done, and which is why the private corporations capex is not going to sort of grow very rapidly. Anyway, we're hitting at 30% GFCF level, maybe 1-2%, meaning that's the total investment as a percentage of GDP. It doesn't have much space. I think the only way we can accelerate the capex overall if we can get households to build more houses, buy more durables like fridge, TV, this, that, everything, two-wheelers. And we want that. And for that, I think a little bit of an easy monetary policy, a little bit of assistance on through credit subsidies for buying two-wheelers, buying houses. If that happens, likely we'll have a capex.
So to be fair, the finance minister had said that this is an interim budget. She has delivered, and she has said more to come in July. Perhaps that's why we are seeing a lot of expectations which didn't make it to the speech, and affordable housing push may be one of them, which is why I just quickly want to also show what real estate is doing. And real estate is getting a bit beaten down this afternoon, perhaps on those expectations that there would be something coming in. In terms of what could be done, and do we have the space to wait for July on pushing out consumption? Let me actually take this question to Mr. Sayta. If you want to put more money in the hands of people, you're not doing it through taxes right now. You've said, as is the tradition, I'm not touching taxes. Fair enough. Could anything more have been done, or we have the room to wait till July for this?
Yeah, I mean, from a tax standpoint, I'm not surprised that she says that we'll do something in July, not right now, which is fair. Also, they want to keep the tax rates a little stable. So that's they've not touched it right now. But I do anticipate some stops maybe in July to ensure there's more money in the hands of pockets of taxpayers. One thing that surprised me a little was she did extend, I think, from the speech, we have to see the fine print, the sunset dates for startups and for IFSC, which were expiring on 31st March 24. There was also the expiry of the concessional tax on manufacturing companies, which was ending on March 24. There was a lot of representations that concessional rate of 15% plus surcharge and cess should be extended for manufacturing units commencing production, maybe till 31st March 25, 26, whatever. That she hasn't mentioned. So does that mean she wants that to consciously expire and new manufacturing units are not going to get that, is one surprising thing, because she did extend it for 2 of those who were expiring, or the sunset was on 31st March 24. But otherwise, she's been pretty silent on taxes, saying I'll pick it up in July. I think the message is clear, which this government has been giving. They want to build a kind of relationship of trust with taxpayers, and say that, okay, let's build that relationship of trust, and therefore taxpayer friendly measures in some sense from a compliance, etc. standpoint is, I think, what she's hinting at. But the real measures on tax will come in the July budget or the main budget, June, July, whenever it comes.
Let me take the question to Shankkar. Is this a populist pre-election budget at all, or they're waiting for all of those announcements before the election dates are announced and when the actual heat and dust hits?
So the answer is in two parts. Every year, somewhere before the budget, some major scheme gets extended. So the free food, free ration scheme got extended last year for next 5 years. Okay. There is also the fact that the Prime Minister has publicly sought responses from various people on what they want in their wish list of the Viksit Bharat. That will form the template for the manifesto. So they have kept some room for the promises now. You can't be giving away everything, then what are the people going to vote for? So there is a combination of this play here. I think it can't be called populist, primarily because it is conservative in its approach. It has brought down the targeted fiscal deficit number is very impressive. The level of borrowings going down is very impressive. And even then the capex going up is stabilizing. I think what's happening here is that the government is betting on the private individual and the private consumption. Private final consumption is virtually half of GDP growth, and that's like a puzzle. I mean, why isn't it growing? Which part of the quintile isn't kicking in? So I think the cost of capital being brought down may kick some animal spirits in the system. And that's what they're... I also think that much of this will reflect in their presentation. One more time, they're making a presentation to the rating agencies for improving India's rating. This has been a constant endeavor of this government that India deserves a better rating. And so they will pitch this 5.1, lower borrowing, inclusion in JP Morgan and Bloomberg, probably one more fund. And see, this is very attractive to the foreign investors, this picture. It may not be very attractive today to the real estate stocks or stuff like that. But on a performance term, this is very good for the financial sector, because there is a potential for bringing down the cost of capital for them.
Ravi, what happens now? Budget is behind us in that sense. We've got what we were looking for, a little bit of it. If you're an investor in this market, how do you view this? What happens next? Does the focus move back to global cues? Does it move back to the elections? Or do we again wait in anticipation for July?
No, I think...
what will you tell your clients at this stage?
I think, as mentioned on the panel earlier, the mantle now moves to RBI. The space has been created. Government has done its bit in terms of providing space for RBI to start implementing its monetary policy. So currently the most important thing that we are dealing with is the liquidity deficit that we are facing right now. And what steps RBI takes to correct that is what is the most important thing from equity markets perspective.
So all that is macro. Yes, last year when the budget happened, you saw sectors like defense and railway break out. Talk to me more micro right now, right? So if I had to pick a sector, what would it be? Do I have a sector? Can I call a trend into this year, or best avoid it for now?
No, it's the continuation of the trends.
So you would still buy railway, you would still buy defense?
We are still focused on domestic cyclicals, domestic capex-oriented stories, domestic... there are some noises being made about affordable housing. So there is some hope that, okay, that will also pick up pace. But otherwise, the weak link continue to be the rural consumption and the exports. Those two areas, I don't think enough has been done for me to say that the trend is going to change over there as of now. And hence, the current ongoing themes will continue. But from the perspective of the valuations, these are the exact areas where market has recognized, and quite a bit of rally has already happened. So a little bit of transition might be underway over the next 6-9 months, where these already recognized sectors might actually peak out, and the ones that are providing the opportunity don't yet have the triggers in place yet, but those are the areas where valuations are getting attractive now.
All right, we'll quickly go across to Janani standing by. She's been tracking the entire budget. She's in North Block. What are the big takeaways, Janani?
That's right, Tamanna. I think we've all heard the big announcements, the numbers that we've been waiting for. But I want to, pull focus to some of the key details here. If you look at, of course, the fiscal deficit, it's now at 5.1. This is a 70 basis point drop from 5.8, which is the revised fiscal deficit estimate for FY24. Now, what I'm more interested is in lakh crore rupees. This is 16.86 lakh crore. Previous year, it was 17.86. So this, again, we can see in actual terms also, there is a big difference. Market borrowing lesser than what it was before, coming in at 11.75 lakh crore. Again, a very interesting aspect here. When we talk about receipts as a whole, an interesting trend that we notice is that the estimation for corporate taxes is actually lower, in fact, than the income taxes this time. Income taxes is at 11.56 lakh crore, whereas corporate taxes is at 10.42. This is a little bit of a deviation, considering that corporate tax expectation is always much higher. Talking of expenditures, the subsidies, ones that we've always been interested in from the beginning when we started tracking this, fertilizer subsidies actually gone down. It now stands at 1.64 lakh crore. Food risen a little bit more considering the extension of the food subsidy scheme. This is at 2 lakh crore rupees, and petroleum subsidy significantly increased at 11,000 crores, 12,000 crores almost. And other important schemes like the Manrega scheme has seen an increase in outlay, but this is very much similar to what was in revised estimates. Manrega scheme's outlay is now 86,000 crores, whereas PMAY, the PM Awas Yojana, one that the finance minister also announced that will be extended to build 2 crore more houses in the next 5 years. That has got an outlay bump from 54,000 that we saw last year to 80,000 crores in the FY25 budget. Three things that stood out for me. I will end with that. Of course, one, the finance minister's focus on deep tech and perhaps investments through that. And the second, of course, is the 1 lakh crore funding towards sunrise sector research for private companies. We'll have to see which shape and form this will take. And of course, the PMGKY enhanced target. No tax cuts, no tax changes, might have been a letdown, but of course, she also spoke about how there'll be a withdrawal of outstanding tax demands. Now, in the back of my mind, this will be a cheer for the industry, considering that up to 25,000 pertaining to FY25 and 10,000 pertaining to FY11 and FY15, these will be withdrawn. This will be a cheer for industry, something that has been litigated for quite some time. Petty amounts, but still an interesting one. Back to you.
Absolutely, Janani. Thank you for that. Janani there getting us all the highlights of this budget, and let's see how markets are responding to it. No big moves in either direction, at least on the Nifty and the Sensex. You're seeing real stocks maybe taking a bit of a beating today, and to be fair, expectations had run up. There were all kinds of fantastical figures being put out there on rail, on what the rail budget will look like, or what the allocation for rail will look like. Maybe a bit of a cool off that we're seeing there on real estate as well. IRB Infra is another one that we can quickly just check and see what's happening there. And, some of these key names maybe seeing some cool off this morning. But, Ravi, let me come to you in terms of big themes that you see playing out. As far as the market is concerned, will the big relief come from that there is no negative news? It's business as usual.
No, there is a positive news. Fiscal deficit number is actually positive.
I think the markets are becoming mature.
Why do you think there's no real response or reaction right now? Because that was definitely not priced in.
That's true. However, as mentioned earlier, this is a vote on account and interim budget, and it is not budget as an event for equity markets anyway has been reducing, in its importance, and this one is even lesser, if I were to say, because of it being a vote on account. So, for all practical purpose, central government and budgeting exercise can only provide this much needle moving impetus to the overall scheme of things. So, the market moving events lie outside of the budget for me. Most of the policy announcements do come outside of the budget. What RBI does is important, what Fed does is important, and how the elections pan out in US and India is what is more important from the market's point of
So
view.
in terms of what the Fed did last night, and of course, all of that paled in comparison to the very hectic news morning that we had and our budget, etc. When everything is digested and goes down, do you think that that's going to be something which is not half bad? A March cut now out of the way, ruled out.
The market
but
was
it's
running
happening this
ahead of
year.
expectations.
Yeah.
It's not that Fed has done anything that they shouldn't have done. It's just that market was running ahead of expectations, and I think some reality check over there. But the fact that we did not have a hard landing last year, and now there are expectations of a soft landing this year, that itself tells you that the strength in the U.S. economy has till now surprised everybody positively.
Are you taking a cash call on your portfolio right now, or are you completely invested?
No, I mean, so cash call is also divided into what the existing portfolios are and what the new money is coming in. First of all, a lot of people are taking a call not to accept new money. That's not the case with us. We are accepting new money.
And you're allocating?
But we are not very aggressive in deploying on that front yet. So we are sitting on about 25-30% cash on new portfolios, but the old portfolios are about 5-10% cash.